in your writing today, you believe that CapEx has bottomed in 2019. What do you see on the horizon that has led you to that conclusion, and what would that mean for investing in 2020?
So look, I think in 2019, what we've seen was a mid-cycle reset by the Fed, which meant that the manufacturing sector really slowed down. You can see that in the ISM numbers. Recently, what we've been seeing is ISMs and PMIs starting to pick up. So if 2019 was a mid-cycle reset as termed by the Fed, then 2020 may be a cyclical recovery period. Now, if that happens, the cyclical sector, which, in equity terms, that would be more value, but in some other areas, more industrial manufacturing, I think that can actually even take the place of the consumer a little bit. We've made a big deal about the consumer holding up the economy. I think manufacturing and industrials, I think they can actually pull some weight as well. And you could get a modest, mild pickup in growth. And I do think the Fed is going to let the economy run hot. The bar is really high for them to hike rates again.
Jim, many would agree with your last statement. The Fed is going to let the economy run hot. And I would guess that should inflation ramp up, and it doesn't look like it's going to anytime soon, that would be included under run hot. But there are risks to running hot. Just right off the bat, I guess the first risk I see is that many are long duration, heavy duration, which you have written about, meaning they're very susceptible to a quick rise in interest rates. With risk parity and volatility low now, if that should kick up, wouldn't that create a series of events that could disrupt the markets?
Rick, you're absolutely right. I think it will. I think the initial stages, though, of what gets rates to actually rise, if it's good data, if it's a recovering economy, a cyclical recovery, the markets will take that very, very positively. But once you get 10-year notes up to 2.2, 2.25%, I think that's really enough. And at that point, if rates rise further than that, that could create a bit of a contraction and then slow down. So the bottom line is that we're probably in a range, have a mild recovery. Yields are poised to move a little bit higher, but they really can't move a whole lot higher. It's going to put a drain or at least a strain on significant economic growth and really, really running hot. I think, look, we're maybe looking at 2% growth for 2020, maybe a little higher than that, but nothing terrible. But listen, the point is that we have been in a global economic slowdown if you look at GDP. I think that we're going to stabilize and even recover. I think that's good news, but I think there's limits to that good news.
Now, in my final thought, I want to go back to where we started. Capital expenditures. There is little doubt that is the missing ingredient to really see some stronger GDP numbers, maybe back in the threes. In your final answer, what is it going to take, and when will these checks be written by the corporate offices to start expanding things like research, development, and other projects?
I think it's happening already, Rick, and I think it's really happening in the IT space. And the thing is that it's a bit of a lag. So I think that we're going to start to see that in the first quarter and then in the second quarter. So I don't think it's going to be very, very long, and I think industrials are going to follow very, very shortly thereafter.